The following is a brief overview of the partnership between TJTCapital Group and Bob Carlson. TJTCapital Group is a Securities and Exchange Commission registered investment advisor. The three managing partners of TJT have a combined investment experience of more than 60 years and a relationship with Bob Carlson which dates back more than a decade. TJTCapital manages the entire client relationship from the establishment of the account to ongoing communication with clients to generating the quarterly reports. Monthly statements, however, are generated by our custodians, either Charles Schwab or TD Ameritrade. Bob is now going to address his investment philosophy. Bob?
Thank you, Tim, and welcome. There are three ways you can invest profitably, and I use all three of these strategies in developing the portfolios we use at TJTCapital. The first way to invest is strategic. This is basically a long-term buy and hold approach to investing most of you are familiar with, but you might not be familiar with the way we do that, and we'll discuss that in a little more detail in a few minutes. Another way is opportunistic, sometimes called tactical investing, and this is where you adjust your portfolio in response or anticipation of changes in the markets or the economy. And the final way is trend following. This is a shorter term based strategy where you follow what's going on in the markets. You sell what's not doing well over recent trends, and buy what's doing well in the hope that it will continue to do that. So that's an overview of three, and let's look at a little more detail on that. First is strategic investing. As I said, this is long-term buy and hold. Many of you are familiar with this concept, but most people and most traditional portfolios do this wrong. To buy and hold profitably over the long term, you need what I call true diversification. We have this in what in my newsletter I call the hedge fund mutual fund portfolio. You want exposures in your portfolio to investments that do well in all the different types of investment environments. You'll have some that respond well when growth is rising, some that do well when growth is falling. The same with inflation. You want some inflation hedges in there, and you want some deflation hedges in your portfolio. So you'll have parts of the portfolio that will be doing well no matter what's going on in the economy and the markets in almost every case. Not in every case. There's some crisis periods, such as when Lehman Brothers filed for bankruptcy, when almost everything declines. But otherwise, you'll have parts of the portfolio doing well at any particular time. To do this, you need both mutual funds and assets that are not included in most conventional portfolios, and also strategies that are not included. And when you do this, when you have true diversification in your portfolio, you'll earn above average returns over time, and you'll have less volatility than the traditional portfolio. Traditional portfolio basically has most of its risk dependent 80 to 90% on the stock market. You're stock market dependent. With true diversification, you get away from being dependent on the stock market, and you have much broader range of profit opportunities, and you'll do well in many other different types of environments. And so we include in part of each portfolio a strategic investment portion. And next up is opportunistic investing. As I said, some people call this tactical asset allocation. Now, this is not short-term trading. It's not day trading. It's not anything of that nature. When there's a position taken in the opportunistic part of our portfolios, we anticipate holding it for a year or longer, preferably 2 to 3 years. That will depend on what's going on in the markets, and also depending on whether or not the choice we made is correct. But this is not short-term trading. We take tactical positions based on either what we see happening in the markets or what we anticipating happening based on what we expect to happen in the economy. Some mutual funds will do this well on their own. Some of them from PIMCO, Berwyn Income, or FPA Crescent, but not many do. There are many mutual funds that try to do tactical asset allocation. Many of them do not do a good job of it. But the way we do it with the TJTCapital portfolios, we can include more assets than many people include. We include assets and strategies that we would not include in a buy and hold portfolio, but that are appropriate for certain points of the economic and market cycles. And so again, part of each portfolio includes some of this opportunistic or tactical allocation. And this is a broad overview of what happens, why we look at the opportunistic strategies. There's a natural cycle for investment assets and also for the economy. You might start at a trough at the bottom, then there will be an expansion, then there'll be a peak where prices go as high as they're going to in that cycle, and then a decline begins. Now, it's not as smooth or as predictable as this chart makes it appear, but that's the general cycle for all investments, for the economy, for the global capital markets, and this is something you should try to take advantage of in your portfolios. Buy kind of near the trough, hold for the expansion, and then sell when it appears to be near a peak. And there are some principles that we follow that make this work better than many other tactical portfolios. One is we focus on risk management. We're not looking to capture the highest returns. We know we'll get returns over time because the natural momentum of the economy and the markets is to go upward. So what we want to do is avoid big risks. We want to look at what needs to be taken out of the portfolio because it's in the wrong part of its cycle or because it's too highly valued. If you focus on risk management as your primary goal, then your returns will take care of themselves over time. We're also looking for value in our investments. We're always trying to have a margin of value in each of our positions as well as in the overall portfolio. We also want to capture a trend before we near the peak. You want to get it fairly early in that expansion phase. A mistake many investors make is they don't buy an investment until it's already making headlines with its returns, and that means you're buying it near the peak, not near the trough, and not in an early part of the expansion phase. So you want to capture emerging trends, not trends that have already clear and have developed. We basically, in the portfolios for the opportunistic part, we simply increase or decrease the allocation to different assets. Some will be eliminated from time to time. Others will simply reduce the position because it's become riskier than we want. As I said, this is not day trading or short-term trading. We like to have a one-year holding period, preferably longer. And also, we know we'll make some mistakes or the markets will turn quickly. So before we buy an investment, we know pretty much when we're going to sell it. Either we'll have a very firm sell price. If the investment falls below that sell price, we're going to remove it from the portfolio. Or we'll be looking at certain indicators in the economy or the markets that will make us sell it so that we don't incur any losses. Okay, and the final strategy that we also include in the portfolios is momentum investing. This is a shorter term. It's still not day trading. We're still not in and out of investments even on a weekly basis, much less a daily or hourly basis. But it's shorter term focused than the other strategies. And what we follow is basically the invest with the winners strategy that I have in the newsletter. We have very clear buy and sell rules. We follow those, and that way we capture momentum when it's clear in the markets. And when an investment starts to turn, we take whatever gains we've achieved and sell the investment and move on to whatever qualifies next for our purchase rules. And there are times when no investment is doing well and qualifies for our purchase rules, so we'll be in cash. So periodically, the momentum strategy won't be invested. It'll just be holding cash because we'll be waiting for a clear opportunity. Because even with this strategy, though it involves more trading, though it's more aggressive than the others, we still want to have a margin of safety in our positions. So that's why we won't buy unless certain factors are present. We'll sell when the sell rules are triggered, and if nothing meets our buy rules, we'll sit in cash until a new trend is established. By taking this approach, we'll have a lot less volatility than many other investment strategies, and I think the experience has shown it'll generate a higher long-term return than a lot of other alternative strategies. So by following these principles and by including momentum investing in a relatively small part of these portfolios, we increase returns and we're going to reduce risk.
Thanks, Bob. Altogether, we want to provide comprehensive investment solutions tailored to meet your investment objectives. Please call TJT Capital Group to find out more.